Let's talk a little bit about tax implications. People are asking about inheritance taxes. What are some of the things that happen after someone passes away when it comes to taxes?
One of the main issues is whether your estate will be subject to federal estate tax. Fortunately, right now, that doesn't affect most people because the federal estate tax exemption amount is very high. However, in 2026, they are considering making changes to that, lowering the number, and it could affect a lot of people. By having a living trust, you can actually take twice the exemption amount if the trust is structured specifically to acknowledge that. So having a trust can help avoid estate tax. Right now, it's not so much an issue unless a married couple has over approximately 26 million, but they are talking about lowering it to 5 million in a few years, and then that could conceivably affect a lot of people. One of the other pieces of the tax implications, you do get a step up in basis in your assets when you pass away. So potentially down the road, if someone passes away and the family wants to sell a property, that property now gets a new basis and hopefully avoid any capital gains tax on the sale.
Can you just kind of identify what a stepped up basis means?
Yes, so if you buy a house, one of the lucky ones that may have been able to buy a house here for $20,000. If you own it all your life and today it's worth $1 million and you go and sell it, you're going to pay capital gains tax on the equity essentially in the house. There's a little more to it, but basically the increase in value once you sell it, you will be taxed on that. So if and when someone passes away and then you go and sell that same property, you are now starting out with a basis of $1 million. And that means if your sale price is $1 million and your basis is $1 million, there is no gain on that sale, so you don't have any capital gains tax liability.
Oh, very good, very good. I've had certain people that aren't ready to sell the family house and they hold on to it for a little while till they're psychologically ready to do this, right?
Sure.
So what happens then? Let's say, for instance, it's $1 million now, and now it's 1.3 in 3 years.
Then you really are in a tough situation. You can either avoid the tax if it becomes your residence, and then at that point there is a $250,000 exclusion. But if someone passes away and the family wants to hold on to it for 3 years and rent it, there's no way around it. There will be capital gains tax on the gain on that sale.
Got it. A lot of times people don't realize is that when someone passes away, you got to do one more tax return. So do you usually refer out to that?
I always refer someone to a CPA just to make sure everything gets taken care of that needs to be done. And it could be a personal return that never was done in the past. You want to make sure everything is brought current. And then also for the trust return, you want to make sure that's done properly.
Perfect.